Hello everyone, welcome to episode 10 of Alternate Universe webinar series, and it's a pleasure to have you all here. I am Ravindran from PMS Bazaar, and today we have an exciting webinar on From Relationship to Result, Building Enduring Client Trust in Wealth Management. In today's dynamic financial landscape, trust is the cornerstone of lasting success in wealth management, and this webinar explores how evolving client expectations demand a shift from transactional interactions to value-driven relationships. To explore more on this, we have our esteemed speaker, Mr. Apurva Sahijwani, Managing Director and Chief Executive Officer at Avendus Wealth Management. With over 25 years of experience in private banking and wealth management, Mr. Apurva spearheads the seasoned Avendus Wealth team, and he is responsible for shaping bespoke solutions for India's discerning ultra HNI client base, fostering strategic business growth. Prior to joining Avendus, he spearheaded Burgundy Private, Axis Bank's private banking arm, and he has also held several key management positions at Kotak Wealth, ICICI Bank, HSBC, and Citibank. Mr. Apurva holds a postgraduate degree in business administration from Gujarat University, and he is widely respected in the industry for his professionalism, team orientation, and acumen. Welcome, sir.
Thank you.
Next up, we have our moderators, Mr. Vikas M. Sachdeva. Mr. Vikas is an investment industry stalwart with over 3 decades of experience in the asset management business. He is currently the managing director of Sundaram Alternates, driving growth across different platforms, geographies, and asset classes. Welcome, sir.
Thank you.
And next, we have Mr. Madana Gopal Ramu. Mr. Madana Gopal is head of equities and fund manager at Sundaram Alternates with over 18 years of experience in the Indian financial markets. He currently manages assets worth around 3,500 crores. Welcome, sir. With that, let's kickstart today's session. Over to you, Vikas, sir.
Thank you, Arvind. Welcome, Apurva. Welcome, Madan. Apurva, I'm actually, I'm conflicted from a point of view. It doesn't seem like we are doing a call, and I'm actually talking to you as a guest here. We've had so many discussions as friends, so I'm actually flitting between thinking that I'm sitting in front of you over lunch, describing things to you, and doing a conference. So pardon me at times if I will just get into a different mode altogether. So welcome to the show, Apurva.
Thank you, Vikas. I'm looking forward to our interaction.
I must tell you, दोस्ती एक तरफ है. I must tell you कि मैंने detective का काम किया है. Me and my team, we've done a little bit of digging around for this section called "Person Behind the Professional," and I've got some feedback which I'd like to share with you. This is across your friends, some of your clients, some of your colleagues. So, well, let me just start off by saying your team actually uses adjectives when we asked to describe you. Your team uses adjectives like grounded, visionary, and disciplined to describe you. They say that you approach everything with quiet dedication and care. The word is quiet dedication. That means you're a very calm person. Your professional growth has been organic. I've been seeing that over the years. You've been in terms of managing client relationships ground up. But this shows up when you talk to your teams, when you explain things to people. You talk about this experience in life, which has instilled a very high level of empathy for clients, understanding their needs, challenges, expectations, which I think your team appreciates. They talk about you as being incredibly thorough and deeply caring about getting things right the first time. It could be a project, it could be a conversation, but you are very clear that you want to get things right the first time. On a more personal note, you're a very avid movie buff and have watched every Fast and Furious movie and every Marvel film, often enjoying them with your daughter Aditi, who's 12, turning on 13 right now, going on 13 right now. Incidentally, I believe Aditi is highly talented. She's co-authored 2 books. She digs quantum physics and is part of a robotics club. I think the Marvel experience is rubbing off onto her.
I agree.
While you love fiction and fantasy on screen, in real life, you actually love reading books which are non-fiction. You're an absolute book lover, and I've been to. I've had glimpses of your cabin at least, in which I've seen a load of books, and I'm sure the same thing is for you at home as well. You love quoting from this book the most important thing. The essays, the memos which Howard Marks has written, often forms part of your conversation. The Art of Thinking Clearly by Rolf Dubelli is another book which you like, particularly from the point of view of behavioral finance. I believe you also dig Jeffrey Archer, but currently you are reading Bulls, Bears, and Other Beasts by Santosh Nair. Interestingly, you picked up learning the guitar some time back and used to play it with your daughter, but found it difficult to pursue with your work schedule. Actually, that makes two of us. Even I picked up the guitar, and the only thing I could play was Happy Birthday to You. And after that, I just left it.
I'm not too far away from there, I can tell you.
Your wife, Deepika, is an ex banker, now homemaker, and an avid storyteller for kids. I mean, I find that so amazing and heartwarming. The family loves traveling, and you have a soft spot. Your family has a soft spot for the outdoors. You recently visited Cotswolds in London, which is a charming place, and you loved it so much you want to come back to it again.
Very much.
Well, here's an interesting insight I found out about you. You love cars. You're extremely passionate about cars. You love Japanese and German engineering. Anybody who makes even an offhand comment about cars is going to get dragged into a spirited conversation with you. You just don't take that lightly. You have a Jeep and a Honda City, and I've been told that you're extra cautious about the vehicles. It should not get scratched. Nobody should lean over it. In fact, one of your colleagues said that God help anyone who comes within a hair's breadth of your car. So I found that very, very amazing. You're a very ardent cricket fan. You actually often use dialogues or anecdotes from cricket in your presentations, in your discussions with your team. Uh, what is very evident is you are extremely well dressed and you take pride in your 140 strong tie collection. I must tell you, this is an inspiration. I used to wear ties quite often earlier. Till the time I was told post COVID, nobody wears ties. I'm truly inspired. I'm going to dig into my tie collection. The next time we meet, I'm going to be wearing a tie.
Thank you. I look forward to it.
You're a true foodie. Your friends actually tell me that you are sort of the go-to person. If anybody has to find an iconic eatery in South Bombay or a hidden gem in South Bombay, you are the one they reach out to. You have a soft spot for seafood. Well, I should have guessed the next part, which is that you love stand-up comedy because you have such a penchant for deadpan humor. It should have been very natural to me that you love stand-up comedy. Last but not the least, and this is what I found very amazing. Your team tells me that you have a razor sharp memory for numbers and you can actually recall long number sequences down to the decimal point. So I'm sure, during appraisals and bonuses, you must be having a very candid conversation right down to the last decimal. I would love to be a fly on the wall and listen to that conversation. So once again, thank you so much for gracing the show, Apurva. Welcome to you.
Thank you, Vikas. My God, you've really done some extensive work on this segment, but it's a pleasure and always nice to speak with you. And looking forward to our session today.
Thank you. So let's just dive right into the questions. One of the things I've often heard, and it's sort of become a maxim with me, is that comfort is more important than conviction when it comes to investments and, in fact, a lot of things in life. And I think underlying behind that statement is basically the word trust. Okay. You've actually been part of this whole evolution you've seen in the industry, in private wealth across top institutions. And you've been around for 2.5 decades. How has this concept of trust evolved in wealth management across the time span that you see?
Well, that's a great way to start off our conversation. I think there's been a significant evolution in the industry over the last couple of decades. And I think there's been a very visible pivot which has happened. I think that pivot, and you'll appreciate this point, because I think the pivot has been that we've moved from information arbitrage to knowledge arbitrage. Okay. Let me explain what I mean by this. I mean, back in the day, as a wealth manager, you had an edge over your clients because you had access to a network where you were relatively higher in the pecking order, right? I mean, in that information flow would come to you first. And in the language of today's generation, like my daughter says, you could flex that advantage. You could kind of use this to win the trust and admiration of your client base. I think if you fast forward to today, this edge doesn't exist anymore. I mean, consider something like the bi-monthly RBI credit policy, right? For the last two policy announcements, we've actually seen RBI cut interest rates, right? Now, whenever there has been a repo rate cut announcement, today you get the information simultaneously with your clients. Perhaps your clients get this information, your client gets this information faster than you do, because she's being served by various wealth managers, and somebody probably would have beaten you to it. Now, the key here is, how do you use this information? The edge, if I may, from what used to have earlier, today is in terms of how do you process this information. Can you today highlight to the client what this, let's say, repo rate cut announcement implies for her portfolio? Can you simulate the impact of this event on the portfolio's performance? Can you use this event to recommend any changes that you might want to make to the portfolio? So this is what I mean by knowledge arbitrage. And to me, for today's wealth manager, it is imperative to consistently demonstrate this edge in the form of knowledge arbitrage. And I think this is something which will help in building, client relationships.
Very interesting. So I quite like the way you put it. Information arbitrage is now moved to knowledge arbitrage. So it's not just information which you're getting. It is the quality of information and the speed at which you're getting, which is actually very interesting. Very interesting. In fact, that leads me to the next question. In an era where products are getting commoditized, I mean, there is very little moat left between launch of one product and the other. What, in your view, truly differentiates a wealth management platform in terms of building lasting relationships?
Another great point, but I'm not in complete agreement with the notion that products today are commoditized. Yes, this may apply to a certain set of products. So today, let's say ETFs, for instance. The only way to differentiate between two competing ETFs is to look at, let's say, fees and tracking errors and so on and so forth. But as you go up the value chain, in terms of the whole, pyramid of complexity, you'll be able to look at various points of differentiation. The experience of the investment manager, the quality of the portfolio, the track record, the speed of decision making, the ability to manage market volatility. All of this, becomes far more important. So I think there are nuances which, a wealth platform should be able to explore to build a more resilient stack of products, which can eventually find their way into client portfolios. And obviously, this will apply across asset classes. This can be, leveraged to build portfolios which should be able to withstand the test of time. And, obviously, we are going to be in volatile, we'll continue to be in volatile markets. So these portfolios should logically be able to navigate the vagaries of the markets. Whether they are public markets or private markets, commodity markets, fixed income, all of this. So I think, these nuances essentially will need to be put to test in terms of the capability of the wealth platform to identify, differentiated products. And this is something which will help you in, kind of demonstrating your prowess to your clients. And over a period of time, this will help you in building long-lasting relationships.
Interesting. Before I hand it over to Madan, I'm sure he wants to ask you a few questions. Just on this part, which you talked about commoditization in terms of the manufacturers' platforms, right? You talked about ETFs. Would you agree? No, I mean, what is your view about the advice which is coming in from wealth management platforms? Is that also moving towards commoditization, or you see a high level of customization happening there?
Quite the contrary. I think there is a very high level of customization which today we are seeing come out of wealth management platforms. Today, the ability, I mean, back in the day when I started working, we used to be told that, asset allocation is very simple. 100 minus the client's age is, the client's allocation to equity. Should be the client's allocation to equity.
Okay.
In hindsight, I thought, how naive were we, right? Because the fact of the matter is that, you could have two clients, both of them, let's say 50 years of age. Are you telling me that today, irrespective of their risk preferences, irrespective of the liquidity requirements, their aspirations, their goals, you would give the same identical portfolio to both of them? I mean, it just sounds counterintuitive, right? So today, with each of these two clients, you probably want to get into an extensive conversation, understand what their requirements are, their aspirations, their goals, their current liquidity requirements, their level of indebtedness, for instance. All of these are critical inputs which will go in terms of devising a portfolio. And then, of course, you kind of actively manage that portfolio over a passage of time. Again, I think it becomes very important for you to kind of keep revisiting the asset allocation because circumstances change, right? Situations evolve. So over a period of time, you cannot work with a static approach. You will have to make it much more counterintuitive and start looking at opportunities where you can build resilience into the portfolio. So I think advisory is in fact becoming even more customized, if you ask me.
Wonderful. Madan, over to you.
Hi, Apurva. Nice talking to you. Good evening. It's a very competitive world. I think financial advisory is as Vikas put it, has become very competitive and a commoditized sort of a thing. But building a long-lasting relationship requires trust, particularly in financial market. And what are the critical elements you think clients plays a lot of importance to build a long-term relationship and trust for a wealth management firm? Also, if you can recollect instances in your from your past where this was tested and then the trust got well established. Yeah, some instances that you can talk about. It will be very helpful for the clients.
I think this is a very relevant question. I think there are multiple elements today which clients look for before they start, wealth relationship. To me, a prerequisite is the capabilities and the credentials of the platform, the vintage and the experience of the key team members, the ability to forecast, the performance of various asset classes. I think, especially considering the fact that we are in extremely volatile markets, and like I said, this volatility is likely to continue. The agility and nimbleness with which, you can manage client portfolio. So over time, what makes these relationships last is the performance of the client's portfolio and the quality with which they are serviced. I'd like to make an important point here that I think, we don't give enough credence to client servicing, but to me, this is something which can never be taken for granted. I think some of the stickiest relationships today are built basis, the quality of service that the clients receive. Again, I think in today's highly connected world, especially, in the ultra high net worth segment of clients, what clients obviously want to look for is the confidence and endorsement from their peer set. Today, our clients are extremely networked, right? I mean, they have, they have their peers, their contemporaries who they can reach out to for feedback and for views on their wealth managers. So a positive word of mouth goes a long way in terms of, building comfort for a client, with a brand, with an organization, with a team, and of course, even with the wealth manager. Sorry, the second part of your question was in terms of...
If you can recollect some instances particular instances where this trust as an element got tested and established in your career.
Sure. I think every time we've gone through a crisis or a sell-off in the market, clients have revisited their relationships with their wealth managers, not necessarily from a trust standpoint, but in terms of their capabilities, right? So I think every crisis has been, in that sense, a bit of a litmus test, where clients have kind of wanted to revisit their basis for working with, a particular wealth manager. But, I think one particular episode comes to my mind, and I think this was 7 years ago, when the industry the fixed income business in particular faced the credit crisis, as an aftermath of what happened with Island FS. You'll recollect, at that point in time, credit risk funds had become a significantly large part of the mutual fund industry. And I think at that point in time, I remember a lot of clients had stocked up on credit risk funds in their portfolios with the expectation of generating, almost equity-like returns, right? Maybe debt plus kind of risk levels. That was the notion, right? That you will get returns which will be marginally below equity with returns which are marginally higher than debt. But this hypothesis was completely shattered, right? And then I think people realized to their complete misfortune that returns from this category of debt funds could be binary. You either get your capital back with the returns, or you may not end up getting anything, right? Now, this was, I think, the time when the level of trust that clients had on their wealth managers was seriously tested. I think, in my experience, this was probably the most testing phase for wealth managers. In fact, the impact of this incident was so severe that for a very long time, clients didn't want anything to do with credit as a sub-asset class.
Okay.
But I think after a lot of efforts, and I think a lot of, if I may add, a lot of education, where, I think clients were kind of highlighted that, credit as a sub-asset class cannot be looked at, in an open-ended kind of construct. If the borrower is raising money for a specific purpose, it's only fair that you see that portfolio of credit instruments through to their logical end. And which is where, I think people then started developing confidence on private credit, for instance, as a category. And over a period of time, including, fund houses like Sundaram Alternates, you've actually now seen a very, very strong category of, private credit ideas emerge. I think, this incident to my mind comes right at the forefront when you look at those instances where trust has been tested, but over a period of time, of course, it has also been rebuilt. I mean, globally, credit is one of the largest asset classes. So there's no reason why, this story will not play out in India as well.
I think you mentioned it right, and your first point that client servicing is an important thing, and part of the client servicing, client handholding during crisis is a very big responsibility for wealth managers. I think you touched upon, and it's a very important point. So, Vikas, over to you.
I was listening to this conversation with a lot of interest. You mentioned about the platform being the more important thing for a credit offering, and you're right. A lot of people tend to obfuscate different offerings irrespective of the platform. Everybody was expecting T+1 redemption in a credit and risk fund, and I think that is something which led to a bit of issues. You also mentioned about the difficulty or the sort of habit changing or mindset changing activity that you needed to do post the credit crisis. Pre that, I think a lot of offerings were made in terms of credit. There were some industry offerings which were made. I think returns. You said the risk-adjusted returns part of it was not mentioned. Only the returns part of it was mentioned. But I think this is something, and I'll just come to the question. I was just building a context. I'm just coming to the question.
Sure.
How do you balance the fine line between performance delivery and relationship nurturing in a volatile market environment? I mean, today it's credit, tomorrow it could be equity, day after tomorrow it could be crypto, for example. So how do you balance this fine line between performance delivery and relationship nurturing? Because in a context, everything looks good. And when the context changes, then you have to manage the client's relationships very, very differently.
By performance delivery, I assume you're talking about meeting your goals, your KRAs, and so on and so forth, right?
Yes. Goals, KRAs, communication, the works.
No, I don't think the two are mutually exclusive. If you ask me, I've had the good fortune of working with some of the best wealth managers in the industry. And the one thing they've all had in common is that they're constantly engaged with their clients. And they've consistently prioritized their clients' interests over everything else. Performance has been an outcome of this relationship. Right? Warren Buffett once said, look at market fluctuations as your friend rather than your enemy. Right? So, fluctuations are bound to be there. We all remember how sharply the market fell when the pandemic broke out 5 years ago. Right?
Okay.
At that point in time, the natural instinct for most investors was to just sell off everything and hold cash for at least the foreseeable future, till the time maybe the vaccine was discovered. Right? Now, during one particularly heated portfolio review, which happened on a virtual call, I saw two generations of clients, of the same family, and they were in complete disagreement on what they should be doing.
Okay.
The younger generation was keen to liquidate everything, right? While actually the senior member, paradoxically wanted to stay invested, right? Now, I was actually more like an observer because, the wealth manager was part of my team at that point in time, made his point using very extensive amount of data. He highlighted how valuations had hit historic lows, and the impact that lower interest rates, which obviously we were in the midst of, would create over a period of time on consumption and capex. Obviously, he made a hypothesis, right? But he backed this hypothesis with a very, very impeccable kind of a logic. And, there was actually a moment in the conversation where the younger guy actually said something like, obviously you want us to stay invested because your revenues are linked to it. And to his credit, the wealth manager actually kept his cool. And he politely told that young guy, saying that, look, the last thing on this, on his mind at that point in time was his personal revenue goals. He said, look, I've been servicing your family, and you're the second generation member of that. But believe me, for me, what is more important is the fact that, we do the right thing for you. And today, I think I speak with some level of confidence here that 5 years later, this is one of the wealth manager's closest relationships. And the family actually holds him in very high regard. So like I told you, I don't think these 2 points are mutually exclusive. You can nurture relationships and you can at the same time deliver performance on what is expected from you, from your organization. Something which can...
Apurva, that there is the foundation of trust, right? That is the moment of truth. The guy didn't lose his cool. He said, listen, your performance matters the most to me. And 5 years down the line, I think, brilliant. That's a great example. In fact, I would just want to proceed to the next question, asking you that this is something you were observing, right? But what are the defining moments in your career that changed your approach to wealth management? You have also evolved over the last 2.5 decades. So what is those moments of truth, those defining moments in your career which change your approach to wealth management?
So, it's actually very interesting that unlike some of my batchmates who worked in multiple roles in across multiple industries, I've been a bit of a one-trick pony for most of the last, in fact, for the entire duration of the last now closer to 27 years. Actually, I've only worked in wealth management. But the difference is I've done a multitude of roles. I started off as a relationship manager, then went on to manage a team of relationship managers, along with managing my own base of clients. Then became a specialist, and then over the last few years, I've had the good fortune of running the business in across two organizations. I think it has with every iteration or every new role that I've done, it has widened my lens. It has given me the ability to look at the you look under the hood in terms of what goes into building a very strong wealth management franchise. And you realize that, yes, of course, it is important for you to have the right relationships. It is important for you to have presence in the right client segment. It's obviously very, very important to have a brand, especially in this business where trust, as we were just discussing, is front and center of every key relationship that you manage. But I think at the same time, it is very important for you to have a great ideation machinery, something which over a period of time is able to churn out on a regular basis compelling ideas which you can work with high levels of conviction. You can take these to your clients. At the same time, it's very important for you to have a very strong team servicing your clients. There has to be a very, very strong backbone which can make sure that transactions get processed, updations happen to client portfolios. At the same time, you also need to have a very strong analytics and advisory team which can draw on the inferences that you generate from not just the environment and macros, but also in terms of how you can use them for building client portfolios and for maybe navigating whatever turbulence comes your way. So I think to me, what has kind of made a big difference is the fact that every single iteration I've done in terms of roles in the wealth management business has helped me kind of understand this business in a more nuanced way, and I've been able to kind of add value to my team and to my clients through every single iteration that I've been able to participate.
But if I have to push you and I have to nudge you and I have to tell you, define one moment which comes immediately to your mind in this entire string of experiences that you've had, what would that be?
I think the one moment was actually doing something other than a client-facing role, because when I've done a client-facing role, and I've done that for most of my career, I continue to engage with clients. But I think, like I told you, once you look at the how of the business, it gives you a very, very very strong understanding of what goes behind building these relationships or over time. Because like I told you, it's not just the engagement, it is not just the brand, it is not just the connect. What do you bring to the table? The proposition by itself, I think that makes a world of difference. And how do you service clients? I think that again makes a world of difference. I was making this point to Madan a few minutes ago. I think we don't give enough credence to the kind of impact proper client servicing has. I've known of instances where clients have continued with the same organization because they are very comfortable with the levels at which they've been serviced.
Yes, you're right. You're right. Absolutely.
Yeah.
Wonderful. Madan, over to you.
So, in our first part of the discussion, you mentioned an important point that one of the things that clients look for is the quality of the team.
Yeah.
So, when as a leader you have built many wealth management teams in your career, what is certain very non-negotiable sort of attributes that you look for when you build a team around wealth management?
Look, the first thing which comes to my mind is obviously client centricity. I mean, unless you have a client first approach, you need to accept that you're in the wrong profession, especially in a business like wealth. The other key trait is collaboration. I mean, in today's day and age, you cannot work in isolation. So, I've always maintained that the wealth manager is the tip of the spear, as far as the relationship with the client is concerned. But the wealth manager also needs to be backed by a very strong team. Like I said, whether it is in terms of service, analysis, domain experts, I think it's actually more like a unit which is servicing a client rather than an individual. And it is this unit which needs to work in tandem. Only then can you give the client the experience which you're promising. And I think this goes a long way again in building trust. Obviously, there are other attributes as well. You need to have patience. You need to have a very long-term approach in building trust with every client relationship. like it is said that Rome wasn't built in a day. So the same thing applies to client relationships, right? It takes years of effort, persistence, engaging with clients, servicing them, which goes to build a strong relationship. Um, Vikas mentioned how I'm influenced extensively by Howard Marks and his memos, and I think one of his pivotal or seminal memos was actually a memo which he wrote after the global financial crisis, which was called "What Can We Do for You?" Now, in that memo, he's actually said that it is imperative that we convey first to clients what we can't do for them, right? What we can't do. We can't see the future. We can't predict, how markets will move, what will happen to the economy, what will happen to various asset classes, various stocks, securities. You can't do that. But the key is to acknowledge what you can do, right? Convey this to clients. What we can do, obviously, despite this whole lack of prescience, is to focus on building asset allocation, looking at the right relevant asset classes. At that point in time, which is what is making more sense, to identify the right set of investments in each asset class, to manage risk, controlling your egos and your emotions, behaving countercyclically, and of course, I think to my mind, one final attribute which I'd like to highlight here is enthusiasm, because unless you're excited and enthused about making a difference to your clients' lives, you really cannot move the needle. You can't build trust. You can't manage relationships. So these are, I think, some key attributes which come to my mind.
When you mentioned that Howard Marks statement that what we can't do is a first point, it reminds me about Charlie Munger's inversion theory. When he says, "I first thing I know is where will I die, so that I'll never go
That
there."
I never go there. Yes, of course.
Nice to hear that. Second point is this is very the topic of most of the world now. Digitization of every business, and the financial space is getting digitized like ever before. And how do you approach this digitization from a challenge perspective for the business itself, or as an enabler of building client relationship? How do you see this digitization as a journey, and how you are approaching in the current setup?
There was a time not too long ago when digitization technology was being looked at as a threat, right? People thought that, the kind of disruption that this will create will be huge. You'll see robo advisory taking over, and, there won't be a need for, individual wealth managers to come in and kind of build their practice. But today, I think the view has changed. Today, technology, digitization is being looked at as an ally. I think it has helped us immensely in decision making. There was a time when preparing for a client portfolio review used to take days, if not weeks, right? Because you had to sift through tons of data. You had to look at massive amount of, attribution analysis and so on and so forth. Today, thanks to technology, the right set of data and analytics is available at your fingertips. This leaves you with so much time, right, for analysis, for decision making. All this data is today available to the wealth manager, and in fact is also available to the client. I mean, today, we have a mobile app which our clients have access to, which gives them not just, a report of what their holdings are, but also, fairly in-depth kind of analysis, in terms of how the portfolio is performed and what is the reason for that level of performance, right? I think the speed of execution has also improved substantially. Earlier, documentation itself used to take a huge amount of time. Processing transactions used to be a very painful kind of an activity. I think this is no longer the case. Today, I think we've reached a stage where clients have started evaluating wealth managers basis the kind of investment they've done in technology. And I think it's no longer a good to have, in terms of the kind of technology budgets that you've created, but it's actually a prerequisite, because unless you have that level of investments in technology, you don't have a competitive edge. So to me, if you've invested extensively, it shows, the conviction on your part, whether it is as an individual, as a team, or as a franchise, that you're committing yourself to this business. You're looking at building, extensive relationships over a period of time. So I'm looking at this as a very, very favorable kind of a step.
What's the general opinion on with the AI and machine learning coming into picture, deep sort of things coming into picture now? You think it will challenge the wealth management as a business, or you think it's a long way to go because it involves a lot of complexity and client-centric sort of advisory role, which is not something which you can just replicate in a machine.
No, I agree. I think our segment of the wealth management industry, which is the ultra high net worth space, is always going to remain very bespoke. And today, clients will always look for, very high levels of customization, which obviously, you will not be able to achieve only through technology. It'll have to be a great interplay between technology and human intervention. And I think it is that interplay which today will make all the difference. So how do you leverage technology to kind of draw the right inferences and then put them into practice is what will differentiate, the way you build your client relationships going forward.
Thanks, Apurva, for answering our questions. Because over to you.
I just listened, I just heard you say about clients judging you by the amount of technology you are using.
Yes. Believe me, I
That's-
mean, it's a fact.
No, honestly, from an asset management firm point of view, we probably don't see that sort of reaction coming in from clients. But this is very interesting that they actually grade you, judge you, benchmark you by virtue of the technology you use, which is very interesting.
Part of pitch meetings where we've spent the most amount of time on the kind of technology capabilities that we have.
Wow.
That's something which has been a very important tick in the box. I mean, box for the clients to take before they've taken the decision to sign up with you.
So is this something which is a part of the trust building exercise you have, say, with Gen X, millennials, Gen Z? So I'm just wanting to understand, how do you build trust across generations? Is this one of the key parts?
Well, see, it's actually not the only thing. I think
I'm
if you
just saying one of the parts, because earlier you mentioned about this experience between the father and the son during COVID, right?
yes.
Yeah. So I'm just building up from that. I'm saying there are different generations now probably sitting with you,
Yeah, which is a fact.
and you have to generate trust. So maybe
Yeah.
one of the factors could be technology. What would be the
Technology
overall
is
package? Yeah.
sure. So look, I think it's very interesting. You talked about my love for cinema, and let me kind of use one example from one of my all-time classics. I know it is a classic for you as well, Vikas, but I think the role of the wealth manager has evolved. It's actually become the wealth manager has actually become more like a consigliere. You understand the
Correct.
drift. Right? I think there is a different degree of involvement when it is today when it's come to managing wealth for families now, and especially in those families where multiple generations are involved. I think we are seeing the new generations become more involved in the entire asset allocation process, which perhaps was not the case earlier, right? Because you had typically the founder, the patriarch, focusing more on the operating business, which is the source of wealth, right? Rather than the eventual utilization or deployment of wealth. Today, the next generation has actually come in there wanting to be far more involved. They want to be involved in deciding the asset allocation. They want to be more involved in terms of selection of the underlying investments. I think they're showing a higher level of affinity towards newer asset classes. They realize that historically they've been overweight real assets, and today they actually want to build more allocation towards financial assets. So, I think the level of engagement has actually increased substantially. At the same time, they're also talking about, their aspirations. They're talking about their concerns. They're talking about, building global portfolios. Hence, I said that the role of the wealth managers today has evolved to become that of a consigliere. And just like Tom Hagen used to exist, for Don Corleone, today the wealth manager should also kind of come in and fill Tom Hagen's shoes.
These are interesting anecdotes. I'm not going to clarify anything. I think people will go and read now what this is. This is amazing, the way you just blended this in. So maybe you would want to use a couple of other examples and anecdotes, because the next question is going to be, what advice do you want to give to independent advisors or distributors who want to move from transactional relationships to a more trusted advisory roles? So what would we want to give? And if there's an example or anecdote you want to give, that would be lovely.
No, I'll draw on something which I just said. I think I mentioned that, for decades as an industry, we've focused on the client's wealth. I think what we have not focused on is the source of the wealth. For an entrepreneur, the source of the wealth is her business. For a professional, the source of the wealth is her occupation. For a celebrity, the source of wealth is again, their profession. I think it's imperative for us to understand the source of the wealth.
Mm.
Consider somebody, again, drawing on my experience, there is a large family which is in the steel industry, right? We now have the third generation, which is actually kind of in the same, in the same business. They've generated their fortune through the steel industry, but they've also seen massive volatility, in the industry, and obviously that has impacted, their net worth, that has impacted their savings and their investments in their business, of course. Now, logically, because the business for this family is cyclical, today, as a wealth manager, what you should do is build a portfolio which is counter-cyclical. So that, when the industry goes through a downturn, they see solace, they find solace in the fact that the rest of the portfolio is actually doing well. So today, for a family like this, the logical thing to do would be to build a portfolio which is perhaps more overweight on themes like consumption, right? Or financials, for instance, rather than kind of, again, investing into, let's say cyclical or, old economy kind of industries. I know of a wealth manager who advises the tech founder of a very large listed company, and he's very clear, in his understanding with the client, that the client's portfolio will have a very minimal kind of an allocation to tech stocks, because there's already a very large skew, right? Since that's been the source of the client's wealth. So I think, to my mind, it's important to look at the source of the wealth, something which we've seldom done in the past. And I think it will give you a lot of insights. So, this will kind of, in a way, force you not to be transactional. This will actually force you to be more holistic. You can actually then take on, like I said, you can widen the lens and you can kind of figure out what more you can do for the client.
Very interesting. Source of wealth. I think that is very interesting. Very, very interesting. We've got a lot of questions coming up, so I'm just going to ask you last couple of questions here.
Sure.
Audience is really giving us a lot of questions to ask. Last two questions. If you had to distill, all your experience into one mantra, maybe you've already answered that question, maybe you've not. So I'm just going to ask you, if you can distill that into one mantra for building trust in wealth, what would that be?
I don't need to think too much about this. I've always made this one statement that, I think, Christianity has 10 commandments. Wealth management has only 2.
Okay.
The first is you shall not put long-term money into short-term assets, and vice versa.
Wonderful. So this is
it's as succinct as it can get. All I'm trying to tell you is that, I think
don't put long-term money into short-term assets, short-term money
and vice versa. Precisely. You follow these 2 commandments, you will never go wrong.
That's wonderful. That's really nice. I'm suddenly thinking of my portfolio.
Thank you. I think the fact that I've been able to set you thinking is something which, to my mind,
honestly,
this is
such a simple home truth, right? But when you hear it and you realize that this is brilliant. So we're going to introduce a section. This is the first time I'm introducing this section, and I'm sorry to just put this on you, but I couldn't think of a better person who would be comfortable with a rapid-fire question scenario. Okay, so
I don't know what to expect now. Yes.
So basically, considering the current market, see, a lot of questions are coming in today's markets, right? What to do? There's a tariff trade war. There's war. There's a lot of things which are happening out there, right? So people are a little jittery, confused, information overload, etc., etc. And knowing your penchant for distilling things and just giving it the way it is, I'm going to ask you questions. You have to choose one of the alternatives. Okay. You have to choose one of the alternatives. Okay. So considering the current scenario, we're not talking about long term. You're sitting in front of a client and, assuming that he's got a very generalized sort of a profile, he's asking you a question, equity or debt?
Equity.
Large cap or mid cap?
Large cap.
Compounding, wait for compounding or get into momentum?
Actually, can I qualify the earlier question, please?
Sure.
Large cap for do-it-yourself portfolios, mid cap for investment managers, third-party managers. Because I genuinely believe that I think mid cap investing is best left to the experts. The margin of error on large caps is generally very, very small. So your do-it-yourself portfolio can be through large caps, but your mid cap portfolio has to be necessarily looked at by investment managers.
I'll make an exception and allow that. Otherwise, you're supposed to be going. That's okay. This is useful. You're absolutely right. Mid cap requires a little bit of a different orientation.
Yes.
Otherwise, you'll be running after the next shiny thing. Compounding. One should get into compounding long term or momentum at this point of time.
Compounding, always compounding. I don't think there is any comparison. At least in my books, there is no comparison.
Growth or defensive? What should be the mindset?
Growth. We are in a growth economy, so we should always swing for the fences.
Gold or real estate?
That's a tough one. I'm inclined to say gold.
Hmm.
I'm inclined to say gold, despite the fact that we've seen gold hit historic highs. But yeah, I think I'll stick to gold.
Wonderful. Would you advise your clients to get into a fixed fee orientation or a performance fee orientation at this particular point of time? What should he get into?
Fixed fee. Why would you want to share the spoils?
Well, I'm so glad you said that because people are asking for performance fee now, and I'm saying this is the time to get into a fixed fee, not performance
Absolutely.
fee.
No, I concur. I think fixed is just the right thing to do. I mean, performance will logically mean that over a period of time, with compounding, and this is one of the points which I made earlier, you will
I'm going to
actually
ask you a really, I'm going to ask you a really tough question. The next one: mutual fund or alternates?
Here I'll say both. I'll say both.
I put you on a spot. And last
No,
but
I'll
not
say
least-
both because I genuinely believe that there is space for both vehicles. See, the underlying asset class could be the same, but they have their advantages. So
Absolutely.
why not kind of play the best of both worlds?
Well, it's interesting because I just want to qualify. This was on a lighter note, which I mentioned. But when we talk to family offices, we did this whole family office report. The
Yes.
rite of passage for any family office is usually mutual funds. Okay, a bulk of their investments go into mutual funds. So I think the industry has done a great job, and I've been fortunate enough to be part of the industry. It's just gladdens the heart to see that mutual funds are there. But alternates are slowly making their mark. And yeah, you're right. It is both. Last question, which is last rapid fire question. I know the answer to that. I'm still going to ask you, which has got nothing to do with your profession. It's Iron Man or Superman?
Iron Man, actually.
I
Like I
knew
said,
the
Marvel
answer.
fan. Marvel over DC any day.
Absolutely, absolutely. I knew the answer to that.
Yes.
So I'm just going to quickly get into the audience questions. There's a prize for the best audience question, Apurva. At the end of it, you will have to choose the best question. And in case you can't, I'll help you. But I think it's going to be you who's going to decide. Wow, there are so many questions which have come in. How should Aksharaj is asking, how should a wealth management platform incorporate digital transformation while maintaining the human touch that's crucial for trust building? And with technology bringing in more data points and variables into investment decisions, how to maintain a balance and avoid being misdirected by more data points? It's a fairly elaborate question.
It's a very relevant question as well. See, I think the essence of every wealth management relationship is how simple can you make it, right? Simplicity is clearly the essence. I think clients are looking for simplicity because the fact of the matter is that this is not their full-time occupation in most instances. In most instances, clients have operating businesses to run, right? Which means every single time we kind of engage with the client, we're actually kind of taking the client away from their operating business for quite some time, to focus on what you're doing on their portfolios. So I think how can you leverage technology to make things simpler for the client to understand, absorb, for you to take decisions, for you to kind of bring in the right kind of edge. I think that's really the whole solution to this. So to me, simplicity creates elegance, and I think elegance is what clients are looking for.
There are so many questions coming in about what Avendus would do. I'll come to them, but I think Ashish Rungta has congratulated Avendus for winning one of the best employers by CFA Society India and Institute. I was not aware. Congratulations. This is amazing.
Indeed, something we're very proud of.
And Pashupati is asking, what metrics or frameworks does Avendus use to measure the effectiveness of client relationships beyond just AUM growth? What metrics do
So
you
look,
use?
one very important metric that we look at is share of wallet, which is what part of the client's wealth is being managed by us. I think it's a very important metric because it goes to show how entrenched you are in every client relationship. The larger the share, needless to say, the more well entrenched you are. That's a very, very important attribute for us. That's something which we look at. We also look at the depth of the relationship in terms of not just the size of the relationship, but also the kind of asset classes that we've covered, the different products that we've kind of introduced into the portfolio, the other services that we've offered to clients, whether it is in terms of lending or succession planning or family office, all of this. So for us, there are multiple metrics, but to me, I think in a pecking order sense, we look at share of wallet, and then of course we look at the depth and width of the portfolio.
And actually, it makes sense. Ultimately, everything manifests in terms of the share of wallet.
Yes.
So whatever you do, whatever inputs go in, it ultimately has to be. That's a brilliant one. Ashish is asking a question about with global market volatility becoming increasingly common, how does Avendus approach global allocations in client portfolios, and how do you navigate potential conflicts between client preferences for home market bias versus global allocation benefits?
No, it's something which we kind of grapple with day in and day out, because at the end of the day, despite the fact that we remain the fastest growing large economy globally, but there are opportunities which today are not available, in markets, whether these are listed or private markets. Today, for instance, there are certain themes which, for you to play those themes, you have to necessarily look at investing outside. What we've done is we have an office in Singapore where we've invested in a strong but a very, very small but a very strong team, which has the ability to look at opportunities globally and work with our clients in terms of leveraging their limited allocation for investing globally to invest in these kind of opportunities. These could be as simple as ETFs, or these could be specific investment ideas which we can take to them. See, we are also mindful of the fact that there is already a very large home country bias which exists in our client portfolios, and you cannot suddenly overnight transform the portfolio into a global portfolio. It's something which has to happen steadily and over a period of time. So that's something which we've done. Till the time we had the opportunity to look at investing through the feeder fund route, which, as you're aware, has been largely closed for most of the last few years. We've been very active on that space as well. So there is a conscious effort to build global diversification into client portfolios, and we've been very, very diligent in terms of introducing those kind of elements as with the passage of time.
There's an interesting question Devesh is asking. What, according to you, is the ideal mix of recurring and transaction revenue in overall revenue for a wealth management firm?
I think this is actually more the outcome, if you ask me, rather than working at this as a bottom-up kind of a thing. I would ideally want to look at this as a top-down kind of a thing, because whether it is in terms of transactional revenue or annuitized revenue, it'll be more a function in terms of what kind of clients you're working with, what are the requirements, what are the expectations, and how do you meet them. So, like I told you, it's going to be more an outcome rather than a conscious effort. Obviously, over a period of time, from a predictability standpoint, you want a higher share of ARR, but that may or may not always be the case. So, that is something which will kind of force you to, at some stage, strike a balance between the two, which to me is, rather than approaching this through a conscious kind of a lens or a fixed kind of a lens, I would much rather, look at this as an outcome of the kind of client engagement that we create, that we build.
If I can just add to what you're saying, Apurva, I think this has been generally a contentious point, saying that transactional revenue actually increases mis-selling and, how much, and in-trail actually does not. I think these debates are ill-informed. You cannot judge by virtue of how a certain commission is paid. I think a lot of other criteria get into advising a customer. And like Apurva mentioned, share of wallet. If you try to do too much of one thing, at the end of the day, the client will respond with his wallet. So it's a good question, but I think it is becoming more and more, for lack of a better word, irrelevant as we're going forward, as advice is becoming more and more important than transactions. So that's what it is. Nala, I think your question on how important do you think is the reliance and adaptation to the new age technology, I think Apurva has already answered that. 𝐀𝐤𝐞𝐸 is asking a question about what is the one single criteria for client retention?
Value add, if you ask me. I don't think
value add. Okay.
Value
Perfect.
add. The value add that you make to every single relationship that you manage, very difficult to quantify, very difficult to kind of bracket into a particular box. But to me, I think value add is a function of various various streams, if you will. One is obviously in terms of the performance of the portfolio. The other is in terms of the method with which you've kind of managed the client's wealth, the kind of diversification that you build, the relevance of the asset allocation that you've created for the client, the readiness of the portfolio to kind of adapt to the client's future requirements. all of this is something which I can kind of aggregate into one particular term, which I think is value add. So to me, value add is by far, the one criteria or the one thing that all of us have to focus on.
In fact, you led with that entire discussion when you talked about information arbitrage and knowledge arbitrage. You started off with that and you're just succinctly putting it across as value add. I think it's a great point. Namit is thanking you for your insights. And the question is, what in your view is the right number of stocks in the client's direct equity portfolio, A? And what should be the weightages, equal weight, market cap weight, or anything else?
I am not qualified to answer that, completely, but I can share with you what I think should be the right approach. I don't think, today, we have the luxury of adding too many stocks into direct portfolios because these stocks have also become, extremely volatile. And today, your ability to kind of cover as many stocks, as either as a client or as a wealth manager is obviously going to be limited. So to my mind, the right number is somewhere between perhaps 20 and 30. You can take a pick as to what that right number is. Why would you want to take an equated call? Because every single, stock would have a different outlook. I think it would make sense to have very high weightages towards the high conviction stocks, the top 5, the top 10, and the rest could actually be over a period of time allocations which you're bringing in either with the intention of diversification in the portfolio or with the intention of having proper representation across some key sectors.
Fair point. I think you answered that very well. Last two questions. I think Wasim Alam is wanting to reach out to you. He's doing a project on hedge funds and he's wanting to see if you or your team could help him out. So if it's okay, I will send across Wasim's email ID to you.
Please do. I'll be delighted to see how we can help.
Thank you, Wasim. Last question. Priyanka is asking. There are still a lot of questions, but I'm just picking this up in the interest of time. Looking ahead, 5 to 10 years, which new asset classes or investment approaches do you believe will become essential components of a well-diversified wealth portfolio?
That's almost like saving the best for the last. No, I'm a bit of a purist here, Vikas. So I will lead with equities. I still think that, despite this being perhaps, one of the oldest and the most established asset classes, I genuinely believe that over the next, decade or so, equities in India will end up creating a lot of value. And I think there are 2 or 3 reasons for that. One is I think we as an economy are, we under-own equities, as compared to our peers in other parts of the world, whether they are developed markets or emerging markets. So I think equities is conventionally been a very under-owned asset class. Although I must confess in the last few years, we've corrected that with a bit of a vengeance, but I still think there's a long way to go. The other thing is the fact that, we're likely to see, a very polarized kind of a market over the course of the next, few years. We've seen, the outcome of just the last 4 weeks, in terms of how turbulent markets have been. And I don't think we've seen anything yet. So, over a period of time, economies which are far more resilient will be economies which will have a very strong captive consumption model. And to me, I think, you cannot look any further than India. And of course, China as well. But I think I'm no expert on China, so I don't want to opine about that market. But the fact of the matter is that I think equities over a period of time will create immense value. So I would still, forget my position as a wealth manager, as an investor, I would still want to continue remaining overweight on equities and domestic equities at that.
Before I ask you to choose the best question, there is one, I couldn't resist asking this question. Asta Srivastav is asking, and I think it's a very sweet sort of a question. Which book would you recommend to read besides Atomic Habits and Psychology of Money? I had to ask you this question.
Well, I was telling Vikas, in earlier conversation that, Howard Marx's the most important thing is something which I've always kind of gone back to time and again. I think it's something which I've really enjoyed reading. Every single time I've read that book, I've come up with more and more insights. I would strongly recommend reading Poor Charlie's Almanac. I think it is it's a seminal book, if you ask me. It's something which the common sense that the book carries, which you can apply, to not just your investing journey, but to all walks of life, is remarkable. I've been a huge admirer of Charlie Munger, and I think, the author in this case has done extensive work in terms of looking at, his approach, not just to investing, but his approach to life. I mean, his ability to weave wit into every single thing is remarkable. I've had the good fortune of, being there for one of the shareholder meetings back in several years. And I think it was probably one of those most defining experiences of my life.
Amazing. I must also tell everybody that when Apurva doesn't find time to read books, he listens to audiobooks. Am I right, Apurva? And tons of podcasts. So he does catch up on Marvel movies, but it does not compromise his reading of books and understanding of books. And I think that's quite an amazing achievement. Apurva, I would request you to, decide which is the best question. What question just comes to your mind, which is what you really enjoyed answering?
I think Pashupati's question was quite interesting. I thought, I had to kind of really put my grey cells to work to answer that question.
Wonderful. So Pashupati, you win a special prize. Yours is the best question. That brings us to the end of the show. Apurva, I think this was an amazing sort of an insight. While you were talking, I was actually making notes. This was information arbitrage to knowledge arbitrage and a couple of other things which you were talking about. So these are moments of truth, and that's what I really enjoy. When I talk to stalwarts like you. So thank you so much for gracing the show. It was nice to have you.
Thank you for having me. It was a pleasure interacting with Madan and you, Vikas.
Thank you so much.
Thank you, sir. Nice interacting with you. Thank you so
all.
much.
Thank you all for attending this insightful webinar on Wednesday evening. Thank you.